Hey guys, my name is Joseph Graff, and today I'm going to be talking a little bit about dividend growth investing. So dividend growth investing is an investment strategy that has been gaining in popularity over the last few years. Today I'm going to talk about what it is and how you can implement it in your own stock portfolio. So without further ado, here's today's video. Alright, before I get started with the video, I want to say go Cowboys. I'm a big Cowboys fan, and the Cowboys beat the Giants last night. We got Ezekiel Elliott back, and I'm pretty excited about this season. So to go into today's video, like I said, I'm going to be talking about dividend growth investing. So the first question that we need to answer is, what exactly is dividend growth investing? And the answer is actually pretty simple. So you think about dividend. It's just companies pay dividends. You are investing in companies that are paying dividends. And then you think about the growth part of that. You want these companies to grow their dividends over time. So in general, dividend investing usually refers to investing in companies that pay a above average or higher than usual dividend yield compared to the rest of the market. Now, dividend growth investing is investing in companies that don't necessarily pay a higher dividend yield than the overall market, but are expected to grow their dividends in the future. One of the reasons dividend growth investing is popular is that it is a little bit more exciting than regular dividend investing. With regular dividend investing, you're usually investing in established companies that don't really have a whole lot of room for growth. Whereas with dividend growth investing, you're investing in companies that, yeah, they pay out a dividend right now, but they're also investing money into their own company, creating the possibility for them to pay out a higher dividend in the future. Another reason a lot of people like dividend growth investing is it focuses on companies that are consistently growing their earnings. So companies, in order to make their dividend payouts, if they're going to increase their dividend, they must also generate higher and higher earnings. Companies that generate higher and higher earnings are typically what would be considered good companies. You know, when you invest in something, you want to invest in something that generates a good amount of money now, but also has the potential to generate more and more money in the future. And I think this is one of the reasons why a lot of investors really like dividend growth investing. It just provides a way for you to receive a return on your initial capital investment in the form of dividends, but at the same time, you're still investing in companies that have the potential to grow. And like I said, this is kind of why it's called dividend growth investing. You're receiving dividends, and you're also getting some growth out of these companies. So if you want to be a dividend growth investor, there's three things that you really need to look at when you are considering a business to invest into. So the first thing, and probably the most obvious to you all, is the dividend yield. You want to look at the dividend yield of the company. Now, usually this could be anywhere from 0 to 6%. If it's higher than 6%, I would look a little closer into the company's financials. That's usually kind of a red flag to me. It's not always a bad thing, but there may be a little more risk associated with that dividend, or like I said, you just need to take a look at that. The next thing you need to consider is, what is the company's dividend growth rate? So historically, how much has the company increased their dividend year after year? Also, how many times has the company increased their dividend payouts? These are all things you need to consider because it'll give you some idea of what the company will probably pay out in the future. Now, I've said this before on the channel, and you need to be careful of this, but just because a company has paid out a dividend in the past or has increased their dividend by a certain amount in the past does not guarantee that they will continue to do so in the future. Especially if there's a recession or just an economic downturn, some of these companies may cut their dividends. So you need to be careful when you're looking at this data, and really look at the company's business model and make your own choices. Try to figure out if you think the company could survive a recession, if they would cut their dividend in a recession. So the last thing I want you all to consider when you are about to invest in a company is, are you going to reinvest the dividends that you receive? So personally, I'm a big fan of reinvesting your dividends. That allows you to build a larger and larger position in whatever company you invested in, and it really takes advantage of compound interest. Now, you could choose to take those dividend payments you receive and invest them in other companies. That's an option. Or, you could take that cash and you could hold on to it. It's really up to you, but it is something you need to consider. And when you're thinking about, okay, how much money will I be receiving in dividend payments 5, 10 years down the road if I choose to hold a company that long, whether or not you choose to reinvest the dividends you receive will make a big difference in that. So as a dividend growth investor, you're mostly concerned with two things: the dividend yield on your stocks and the dividend growth rate of your stocks. Now, usually stocks tend to form a spectrum. You have high yield down to high growth. So a lot of the stocks that are paying out a high dividend yield right now, such as Coca-Cola or Verizon, they might have some potential to grow their payouts in the coming years. But for the most part, these are usually considered to be mature companies and will not raise their dividend a huge amount over the next few years. That being said, the advantage to investing in higher yielding stocks is that you are receiving higher payouts right now. And whenever you receive that capital, that higher dividend payment, you can reinvest it back into the companies or invest it into different companies. So investing in higher yield stocks does have its benefits. Now, as you go over towards the high growth side of things, you have companies that are like Waste Management and Leggett Platt that I listed as kind of in the middle between high yield and high growth. A lot of dividend growth investors will like stocks from here over because, like I said, they are dividend growth investors. They're looking for a higher payout in the future. A good place to look for companies that are likely to grow their dividends in the future is the Dividend Aristocrat Index. I've talked about that in some past videos. I'm actually taking advantage of that index, using it in my M1 Finance portfolio. But what that is it is a collection of, it's around 40 or 50 companies that have increased their dividend payments for the last 25 years. So, as I said earlier, just because a company has raised their dividend in the past does not mean they will continue to do it, but it is certainly a good place to look. And a lot of these companies, that's something that they pride themselves in, being able to raise their dividend payouts every single year. It's one of their main foci. Like I said, check out the Dividend Aristocrat Index. It's just full of companies that have a high chance of raising their dividend in the future. So back to my spectrum. At the other end of the spectrum, you have companies that maybe they just started paying a dividend not too long ago, and there's pretty high expectations for them to increase that payout in the future. So companies like Apple, Visa, and Lowe's. I'll talk a little bit about Apple. So Apple, as you all know, it is a technology company. Technology companies usually don't pay very high dividends, but Apple's kind of a special case because they've kind of began to mature. They began paying their dividend again in 2012, and they have kind of slowly, steadily increased it over time. The dividend yield right now is pretty low, but I think a lot of people are expecting Apple to grow that in the future. Visa is a kind of extreme case of a high growth dividend paying stock. Their yield's very low right now. I think it's like around 0.5%, and it might even be lower than that. But based on the earnings that Visa has, the amount of money they're earning per share, there's a very high chance that Visa will pay out a higher dividend in the future. So just kind of keep this spectrum in mind when you are selecting stocks to invest in. If you invest in a stock that pays a high yield right now, you're likely giving up the chance to earn higher payouts in the future. You probably you still have the chance to earn higher payouts in the future, but they probably will not increase at the rate that these high growth dividend stocks will increase their dividends. So I wanted to thank you all for watching this video today. I hope you all learned something. If you enjoyed it, please hit the like button. Please subscribe to the channel. It really helps me to keep this channel going, to keep putting out content like this. And thank you all, and take care.